If you're a stock trader, should you be using stop loss orders? These are the order type where you automatically get exited from a trade if it hits your predetermined loss limit. So the question is, should you use them at all? And if you do, how should you use them? Well, I've been trading for 30 years and I can tell you that it is essential, if you're going to be a good trader and a profitable trader over the long run, that you limit the size of your losses. You're never going to be right all of the time in the market. Sometimes you're going to be wrong. And when you are, you have to limit the damage. However, this is a big however, most people don't use stops correctly. So in this video, I'm going to go into the theory behind why you should use stops, where you should put them, and then I'll go through an example and demonstrate how you should do that. All right, so let's begin with a really important understanding of the market. It's essentially a war between buyers and sellers. Yes, stocks are all about company fundamentals and their valuation and all that sort of thing, but stocks go up because the buyers are stronger than the sellers. Stocks go down because the sellers are stronger than the buyers. And when you look at what's going on in the market, what you're really looking at is that battle that goes on every day, every minute, every week between the buyers and sellers. If the buyers are stronger, they pay more for the stock, the price goes up. So when you look at a stock chart, we're going to look at an example in just a moment, what you're really looking at is the outcome of that war between buyers and sellers every day. So let's jump into this chart here. This is one we're going to use for an example today. TGTX generally went up quite nicely through here, but it also had a period when it went down. So you can see in this period, the sellers were in control, and in this period, the buyers were in control. And within this period that the sellers were in control, you had shorter periods where the buyers were strong, sellers were strong, sellers were strong, buyers were strong. All right, so that's how that war plays out. Essentially, if price is going down and there's falling tops, then the sellers are winning. And if price is going up and there's rising bottoms, then the buyers are winning. All right, so with that in mind, you need to understand that because it's going to make a lot more sense when I tell you where you should put your stop. Let's use a simple breakout strategy on this stock. So what we're looking for is the stock that's going sideways, kind of quiet, kind of boring, and then it comes alive with some abnormal price movement and abnormal volume. And if you watched any of my videos in the past, you'll know that that's a big thing for my approach to the market. I want to see evidence in the market activity that some investors have found a reason to pay more. And because I recognize that the stock market isn't fair, some people get better information than others, those breaks from low volatility, those surprise moves to the upside have meaning, okay? So going back to our chart, right here, we have a day when there's abnormal volume and abnormal price movement surprising the market. That stock had been going sideways for, 6 or 7 weeks, boring, quiet, sideways trading. There was optimism because we had rising bottoms, so that's a sign of optimism. We had a line of resistance here at about $9, and then the stock broke out through $9 from resistance, from optimism, and that was a good sign that the stock was going to go higher. Okay, so that's the buy signal. We don't need to worry about that so much in this video. The question now is, where should the stop go? Well, the answer to that question goes back to this idea that the market is a war between buyers and sellers. If the sellers are winning, price goes down. If the buyers are winning, price goes up. So I always go, when I'm setting my stop, to the last place that the buyers took control from the sellers. And that's really where the stock stops going down in the recent past and starts to go up. So let's go back to this chart example that we had here. So we can see that price went down to this level right here, $7, before it started to go up. So the information wasn't very exciting. The stock was moving lower. It had a bit of a bad day, hitting $7 a share. And then the next day, it did that breakout. So that's where control changed between the buyers and sellers. So if we're going to buy the stock on the breakout day at 10.50, we should say that our stop loss point should be at $7. Now, the stock market isn't perfect. It will sometimes have little moves below support during the day and then it starts to go up higher. So even though I can say that support is at $7, I always want to give a little bit of extra wiggle room. So if my buy point is there at 10.50, let's round it off, and my stop or my support price is at $7, I'm going to go a little bit below that for my actual support. I might go 675, 680, 650, something just a little bit below. Because if you've used stops in the past, you will know that sometimes the stop triggers your trade, like it gets triggered, you take a loss, only to watch the stock go right back up again. That's really frustrating. So if you put your stop in the right place, it's better to do that. And I'm interested to know how many of you have had that happen. You've used a stop, got stopped out, only to watch the stock go higher. Leave your comments in the video and we'll see what the general consensus is. One of the reasons that that happens is using a stop that's too tight. So many people use a percentage stop. They'll say, well, if the stock goes down 10%, I'll get out. Or if the stock goes down $1, I'll get out. Well, that doesn't make any sense when you're trading different stocks, because every stock has a different amount of volatility. And so applying a arbitrary 10% rule to Microsoft is very different than applying that arbitrary rule to a small biotech company that has a lot more volatility. So that's why we want to get away from this idea of percentage stops or dollar stops and look at the chart and let the difference between the entry price and where your stop loss is determine your position size. You know, in this example, if our entry is at 10.50 and our stop is down here at 6.50, that's $4 a share in risk. If you buy 1,000 shares of that stock, that means your risk is $4,000. Hey, I hope you're enjoying this video. If you want to learn more about how I trade the market, how I invest in the market, I encourage you to join me for one of my free presentations. They're more like an hour long, a deeper dive into trading, and you're going to learn some really valuable things that'll help you do better in the market. To register, they're all free. Go to Stockscores.com, go to Trader Training, upcoming events, and there you will see a list of all the different events that are coming up, and you can register online right away. You'll get an email confirmation, and I'll see you at one of those presentations. Are you comfortable with that amount of risk? Because if you aren't, you need to take your position size down. Don't buy 1,000 shares. Buy whatever amount of shares gives you a risk that's tolerable. Now, what most people do is they say, well, I can afford, based on the cash that's in my account, I can afford to buy $10,000 worth of this stock. And then they say, well, I don't want to lose more than $1,000. And so they buy 1,000 shares at $10.50. That's $10,500 trade. They only want to lose $1, so they put their stop really tight. And then they end up getting stopped out right before the stock goes up again. So again, going back to my question, how many of you have been stopped out only to watch the stock go higher? It may be that the reason that that happened was because your stop was too tight. Give it room. I have a saying, upward trends in the stock market start slowly and end quickly. You have to be very patient with your trades early in their life because it takes a little bit of time for that trade to start to gather momentum. So having a wider stop, even though it means a larger percentage loss potentially, also means that your probability of success goes up. You have a lower probability of getting stopped out if you have a wide stop, and that allows you to be there for when the stock actually moves. All right, so in this case, this stock went up fairly nicely. It went up about 2.5 times its risk. So if this is what we call risk, the difference between our entry and our stop, you always want to think about, what do I actually earn on my trades? Does the risk reward make sense? Now here's why that is. Your winners have to pay for your losers. And if you use stops that are too wide, there's too much volatility in the stock, and the stock can't make enough reward to justify the risk you had to take, that's also not a good trade. So there's a fine balance that goes on. You don't want to have trades where you have a really wide stop, because the risk reward ratio that you will earn on that trade isn't going to be very effective. And let me show you an example where buying later at a higher price was actually better. So here's VKTX. And if we go back to this idea of buying a abnormal breakout from low volatility, from optimism, good buy signal there, right? Okay, so where's the last point when the stock stopped going down and started going up? Well, it's right here. All right, the difference between those two is your risk. And because this stock made a big price gap and then made a considerable gain that day, that difference is massive. It's like 50% downdraft. But more importantly, relative to how that stock normally trades, it's a huge move. I will not take that kind of a trade because the distance down to where support is on the chart is too wide. Now, what if we took the same stock and waited for another entry signal, but one where the difference between the entry price and the stop loss price is much narrower? Look at the chart, see if you can see that. I'll show you now. So we have the initial break here, and then there's a little pennant pattern that builds there, and there's a breakout right here. Now I can be a buyer here, which is obviously higher than this price, but my support is only here now. It's a much tighter spread between entry and support. And so at this point right here, the trade is up 1 times risk, 2 times risk, maybe 2.5 times risk. If we took that original trade, there's 1 times risk right there, and here's 2 times risk way up here. So that wider entry, this one right here, the first entry, is only up I'm eyeballing it, 1.3 times risk, whereas the more expensive entry is actually up 2.5 times risk because the difference between the entry price and the stop loss price is much narrower. All right, so these are all the concepts that go into using stops. And I'm pretty sure that most traders don't think about this. To be successful in the market, you have to be good at losing. You have to put your stops at the right place and expect that some of your trades aren't going to work. I go into every trade not planning to win, planning to lose instead. I plan to that point where I'm going to take the loss. I don't plan to win. I don't limit my upside. That's silly. Don't limit the upside. Sell when the stock gives you a sell signal. But when you hit your downside target, when you hit that floor and a little bit below it, time to get out, move on, limit the size of your losses so you can be successful overall. Now, if you've enjoyed this video, I've got another video on trend lines, which is really essential. So I've put a link up here in one of these corners up here, and you can take a look at that. I'd appreciate it if you subscribe to the channel. If you enjoyed this video, click on the like button. The more likes we get, the more videos I do. So let's see what you can do on this one. I thank you for joining me on this video on using stops. I hope it's helpful, and I hope going forward you trade well.